So for the last few years, China's been doing something that hasn't been done ever in modern history, which is to relink gold directly to its currency. In simple terms, China wants to rebuild how money works. Over the last few years, the People's Bank of China has been the biggest buyer of gold in the world. China and its allies are buying gold and selling treasury bonds in order to damage the dollar's reserve currency status. At the same time, China has built the Shanghai Gold Exchange, already the biggest physical gold marketplace in the world. They opened a new vault in Hong Kong and are building a gold corridor, a network of vaults across BRICS countries that will allow countries holding Yuan to redeem into physical gold. That gives China's currency something the dollar has arguably lost: trust. Because gold can't be frozen or printed, is harder to debase, and can't default the same way treasuries and dollars can. As of July 2025, gold has reportedly been reclassified as a Basel III Tier 1 asset, meaning it now counts the same as cash or treasuries on a bank's balance sheet. The theory is the next step would be upgrading gold to HQLA, which stands for High-Quality Liquid Asset, unlocking its use in repo and financing, the plumbing of the financial system. This would allow countries to fund themselves using gold as collateral, outside the dollar system. Trust in the dollars has been eroding since events like the freezing of Russia's foreign reserves in 2022, prompting central banks, especially in emerging markets, to reduce exposure to U.S. assets and buy gold. China's publicly visible accumulation coincided with tariff tensions and has accelerated. Officially, the PBOC reports 2,300 tons, but estimates including state banks and sovereign funds suggest 3,500 to 5,000 tons. Under Basel's old rules, gold was a Tier 3 asset with only 50% of its value recognized on bank balance sheets. Basel III improved this, but gold is still not broadly used for repo. The HQLA step would change that. If gold joins the HQLA list, currently dominated by U.S. treasuries, countries could finance ports, factories, and power grids by depositing gold as collateral and borrowing, potentially in Yuan, without using dollars. At recent BRICS discussions, China addressed two obstacles to using Yuan: trust and volatility. The gold corridor decentralizes custody across multiple national vaults connected to the SGE, with bar tracking and verification. To mitigate price swings, settlement could use moving average pricing, for example 200-day average, rather than spot stabilizing collateral values. Resource-rich regions, for example parts of Africa, could deposit gold into the SGE and borrow yuan via institutions like the New Development Bank to fund infrastructure, circumventing dollar funding and the IMF. This effectively turns gold into an active financial instrument. If institutions shift reserves toward gold, for example from 20% toward 30%, that could imply roughly trillions in new demand and materially higher gold prices over time. The broader picture is a parallel financial system: gold collateralized financing led by China and BRICS, competing with the dollar-centric system. The US might counter with its own advantages, potentially including technology, stablecoins, or Bitcoin, leading to a multi-monetary world with competing collateral standards. Asset prices, gold, and possibly Bitcoin, could reprice quickly over a 5 to 10-year horizon if these shifts materialize. To understand how this could affect the economy of Britain, let's look at it from 10 different angles. 1. City of London's role in global gold and collateral markets. London is a historic hub for physical gold trading and custody, which are LBMA and OTC clearing. A shift of physical custody and price discovery toward the Shanghai Gold Exchange and a BRICS gold corridor could, first of all, erode London's market share in vaulting, clearing, and price discovery, pressuring fee income and ancillary services, legal, compliance, logistics, insurance. It could also prompt regulatory and product innovation in London to stay competitive. For example, yuan-linked gold products, cross-margining with gold collateral, enhanced interoperability with Asian venues. 2. Collateral plumbing and UK banks. If gold attains HQLA status and is used in repo, UK banks and dealers may rebalance collateral pools toward gold alongside gilts and other HQLA. Potentially reduces reliance on the U.S. Treasury collateral in London-based dollar funding markets, slightly changing haircuts, funding costs, and collateral optimization strategies. The Bank of England may need to update collateral frameworks, risk weights, and haircuts to integrate gold in liquidity operations if global norms converge that way. 3. Sterling. Financing conditions and spillovers. A gradual dilution of the dollar's dominance in global collateral and trade invoicing can increase FX regime complexity and basis volatility across dollar, yuan, and gold-linked funding. Sterling markets, deeply interconnected with dollar funding, could face higher co-SS currency basis variability and episodic funding stress or opportunity. For gilts, shifts in global risk-free preferences, causing more gold, fewer treasuries, could indirectly influence term premia in advanced economy bond markets, including the UK, affecting government borrowing costs. 4. Trade invoicing and corporate treasury management. UK corporates trading with BRICS may encounter more yuan or gold-referenced invoicing and collateral requirements. Treasury ops may need new hedging toolkits, like gold basis and yuan gold cross-risk, broader liquidity lines, and revised working capital practices. London could grow as a cross-hedging and structuring nexus for firms bridging dollar, sterling, yuan, and gold exposures, an opportunity if the city adapts rapidly. 5. Commodity pricing, imported inflation, and BOE policy. If commodities increasingly reference gold or a multi-currency basket, pricing frictions and transitional volatility could raise import cost uncertainty for the UK, notably energy and metals. Higher or more volatile commodity prices would complicate the Bank of England's inflation targeting, potentially requiring tighter for longer stances during transitions, with growth trade-offs. 6. UK reserves, valuation, and policy optionality. The UK holds meaningful gold reserves. If gold re-rates structurally higher and becomes more usable collateral, the BOE gains. Valuation tailwinds on reserves. And optionality to deploy gold more actively in liquidity operations or as part of swap lines with partner central banks, enhancing crisis backstops. 7. Financial services, exports, and regulatory positioning. London could lose some custody or clearing revenues if physical flows migrate east, but can defend and even expand high-value services. Structuring of gold collateralized financing for EM infrastructure. Development of standardized documentation, governance, and verification frameworks for cross-border gold collateral, areas where English law and UK institutions excel. Proactive alignment with international standards like LBMA SGE interoperability, bar tracking protocols, and ESG provenance could keep London central to the new workflow. 8. Geopolitical alignment and sanctions architecture. As more countries can fund outside the IMF or the dollar system, the effectiveness of Western sanctions could be reduced at the margin. Also, the UK, closely aligned with the US and EU, may see shifting patterns in compliance, KYC, and AML expectations and flows, increasing complexity and costs for London institutions. Conversely, UK expertise in compliance could remain a competitive advantage if demand for sophisticated screening and governance rises. 9. Capital markets, savings, and pensions. If gold structurally appreciates or gains collateral status, the UK asset managers and pensions may incrementally raise strategic allocations to gold or gold-linked instruments for diversification, duration hedging, and collateral utility, as well as increased product innovation, including LDI-compatible gold collateral, funded notes, repo-eligible wrappers, could occur in London. 10. Net risks and opportunities. The risks here points at loss of London's share in physical gold custody, higher FX and funding volatility, transitional inflation pressures, compliance burdens in a fragmented system. On the contrary, this could reinforce London as the premier cross-system hub, bridging dollar, sterling, yuan, and gold. Expanding derivatives, clearing, and structured finance services such as monetizing legal, standard setting, and verification leadership will also come along. The bottom line is that, if a parallel gold collateralized financing system scales, Britain's real economy will feel it mainly through the financial channel, funding costs, City of London revenues, trade financing, and imported inflation dynamics. The UK can mitigate risks and capture upside by updating BOE collateral frameworks and market infrastructure to accommodate gold's broader role, supporting LBMA SGE interoperability and provenance standards, encouraging product innovation in hedging and collateral transformation, deepening yuan clearing and cross-currency market depth in London. Done well, the UK can remain a pivotal intermediary in a multi-monetary world, preserving high-value financial exports and gaining resilience, even as some physical gold activity gravitates east.